Hey everyone, welcome back to Corporate Decoder, the place where we decode the messy financial documents filed by publicly traded companies for you. This week we're looking at Olo Inc, and let's just say things got pretty interesting there, or perhaps I should say they got pretty final. Olo Inc filed this report on September 12, 2025, the day after a major event happened. We are going to dive into what exactly that event was and what it means for anyone who may have invested in Olo. This is essentially Olo's final official report as a publicly traded company. So the earliest event reported here is September 11, 2025, and that's because the actual big news, the reason they're filing this form, happened on September 12, 2025. This report is all about acknowledging that Olo is no longer going to be trading on the stock market. They were acquired, a deal was finalized, and as a result, they are now a private company. Olo Inc. formerly traded on the New York Stock Exchange under the ticker Olo, but that is all in the past now. The company announced a significant change in its ownership structure, a full acquisition. This means that all of Olo's shares that were previously available for trading on the open market are now held by a new controlling entity, and the company is no longer public. Let's break down what this really means. Olo Parent Inc., formerly known as Project Hospitality Parent LLC, acquired Olo Inc. The deal was officially closed on September 12, 2025. Olo Inc., as we knew, it is now a wholly owned subsidiary of this new parent company. Think of it like Olo Inc. got completely absorbed by another giant entity. The agreement that made all of this happen was signed back on July 3, 2025. This report details the completion of that merger. As a consequence of this acquisition, Olo had to wrap up some of its existing financial agreements. Specifically, they terminated their second amended and restated loan and security agreement from June 2022. This meant they paid off all outstanding debts, everything owed for principal, interest, and fees on that particular loan. It's like closing out all loose ends financially before becoming a private entity. Now, this is where the juicy details for shareholders come in. At the moment, the merger officially happened, which is called the effective time every single share of Olo's Class A and Class B common stock that was out there being traded was automatically cancelled, and in exchange for each of those shares, shareholders received one pleb and it law ex in cash. So if you held Olo stock, you got $10.25 every share you owned. This is a pretty common setup in these types of buyouts where a private company acquires a public one. The public shareholders are cashed out and the company continues its life away from the public eye. The deal also addressed stock options and restricted stock units, which are basically ways employees get paid in company stock. For options that were in the money, meaning the exercise price was lower than the buyout price of $10.25, those were pretty much converted into a cash payout, buyout price, and the lower exercise price multiplied by the number of shares the option covered. Options that were not in the money or were otherwise out of reach were just cancelled with no payout. For restricted stock units or RSUs, if they were already vested, they also got converted into cash. The cash amount was simply the number of shares those RSUs represented multiplied by the $10.25 buyout price per share. For unvested RSUs, the situation was a little different. Those were also converted into cash payments, but this cash was tied to continued employment. Essentially, the cash amount was calculated similar to the vested RSUs, but the payout schedule and the condition for receiving it was based on when those unvested units would have originally vested and if the employee was still working for the company at those future dates. This also applied to performance-based restricted stock units, also known as PSUs. If these were already vested based on meeting performance goals, they were cashed out at $10.25 per share. If they were unvested but had met their performance goals, they were converted into cash that would be paid out over time contingent on continued employment. For those PSUs that hadn't met their performance goals yet, they were also converted into cash cents per share. If they were unvested but had met their performance goals yet, they were also converted into cash, but the calculation of how many shares they represented was based on the company determining in good faith what performance levels were achieved right before the deal closed. The flip side of being acquired is that you have to unlist from the stock exchange. So Olo notified the New York Stock Exchange about the merger and requested that their Class A common stock be delisted. They also plan to file a Form 15 with the SEC to formally deregister their common stock and suspend their reporting obligations. Basically, they're saying goodbye to life as a public company and all the associated reporting requirements. Trading on the NYSE was halted on the day the deal closed. This section just confirms all of what we've been talking about. Because of the merger, every shareholder's rights essentially changed. They no longer have rights as stockholders of Olo Inc. in its public form. Their only right now is to receive the cash payment from the merger. This is a formal declaration that a change in control has happened. As of the effective time, Olo Inc. officially became a wholly owned subsidiary of the acquiring company. The total price tag for this acquisition was approximately $1.75 billion. The funds for this massive buyout came from equity contributions from funds managed by Thoma Bravo LP, a well-known private equity firm, and also from third-party debt financing. With this change in ownership comes a change in leadership. Several members of Olo's board of directors resigned as of the effective time. These included Noah H. Glass, David Cancel, Brandon Gardner, David Frankel-Lee Kirkpatrick, Daniel Meyer, Colin Neville, Linda Rottenberg, and Zuhair Washington. Noah H. Glass, who was the Chief Executive Officer and Principal Executive Officer, is still listed as signing off on this report for Olo Inc., dated September 12, 2025. This suggests he remained in his role at least through the closing of the transaction. The original directors of the acquiring entity merger sub, which was Hudson D. Smith Jr., and Peter Hernandez became the new directors of the acquiring entity merger sub, which was Hudson D. Smith Jr. And Peter Hernandez became the new directors of the acquiring entity. The existing officers of Olo also continued in their roles under the new ownership structure. On top of the merger payout, some key employees received special bonuses called transaction bonuses. These were paid out on the closing date for employees like Peter Benavides, Joanna Lambert, and Robert Morvillo, assuming they were still employed through that date. Each of these individuals received a $400 bonus. There were also some important amendments made to the stock unit agreements for a few key people on September 11, 2025, the day before the merger closed. These amendments affected Noah Glass, Joanna Lambert, and Robert Morvillo. For Joanna Lambert and Robert Morvillo, their RSU agreements were amended to provide for immediate full vesting right before the merger closed. For Noah Glass, his PSU agreement from March 2024 had a portion of his performance-based units converted to be time-based. This means instead of vesting based on company performance, they would now vest based purely on him staying with the company until a specific date, which was set as December 31, 2026. Joanna Lambert's PSU awards also saw similar adjustments, with portions of them being converted to time-based vesting. Her awards granted in March 2024 and now vest in monthly installments over a period stretching into March 2027, provided she remained employed. Robert Morvillo's PSU agreement from March 2024 also had performance-based units adjusted to time-based vesting. These would vest in monthly installments from October 2025 through June 2027, as long as he remained employed. As part of the merger, Olo's core founding documents, the Certificate of Incorporation and bylaws were amended and restated. These updated documents reflect the new structure of the company as a private entity and subsidiary of its parent company. And finally, under exhibits, we see the actual merger agreement referenced, which was filed back on July 3, 2025. We also see the amended and restated Certificate of Incorporation and bylaws as exhibits 3.10. We also see the annual review agreements for Glass Lambert and Morvillo in exhibits 10, 110.2. And there are the crucial amendments to those PSU and RSU agreements for Glass Lambert and Morvillo in exhibits 10, 110.2 and 10.3. The report is signed off by Noah H. Glass as Chief Executive Officer and Principal Executive Officer, dated September 12, 2025. So what's my take on all this? Olo's journey as a public company has officially come to an end. For the shareholders, it was a pretty clean exit with a cash payout of $10.25 per share. This is a decent outcome for them, especially considering the generally volatile nature of tech stocks. The $1.75 billion Olo, and believe they could grow it better as a private entity without the constant pressure of quarterly public reporting. The amendments to executive stock units show perhaps a move to retain key talent through this transition by ensuring some of their long-term incentives are tied to continued employment rather than just immediate merger completion, though the performance aspect for some was modified. It's a common strategy to keep the ship sailing smoothly during and after such a big ownership change. The main risk for Olo now is simply executing their business strategy, effectively under new private ownership. The opportunity is also there to focus on long-term growth without short-term market scrutiny. Overall, this filing marks a significant turning point for Olo Inc., a full transition from public to private with a clear financial outcome for its former shareholders. What do you think about this acquisition and the cash out for shareholders? Let me know.